Did you know that you can buy ready-made portfolios of dividend growth stocks? A good way to do that is to buy a Dividend Growth ETF, which stands for Exchange Traded Fund. You buy the ETF and the fund does the rest of the work. You can buy as little as one share of an ETF and you get slices of its whole portfolio of stocks. You simply hold the ETF and collect the dividends from the portfolio that resides inside the ETF. In this video, I'll show you how to do that. Hi, I'm Dave Van Knapp with the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up button if you appreciate this content, subscribing to the channel, and ring the bell to get notifications when we post a new video. About 200 ETFs use dividend strategies in selecting their stocks. These ETFs range in size, as measured by assets under management, from $67 billion at the high end down to just $2 million at the low end. In this video, I'm going to bring your attention to the largest and most promising dividend ETFs and explain a ranking system I developed to boil down those 200 ETFs to the top 15 that are most relevant to dividend growth investors. I will present my results in three categories: the best all-around dividend growth ETFs, the highest yielding ETFs, and the fastest growing ETFs. At the end, I will identify what I think is the best dividend growth ETF, and I'll show you how it works, how it gets its outstanding results. Before I show you the actual ETFs, I want to make sure that you know what ETFs are and how they work. If you already know this stuff, just skip ahead a minute or two in the video. This display summarizes the important points about exchange-traded funds. The letters ET in the acronym ETF stands for exchange traded, and the letter F stands for fund. ETFs trade on stock exchanges and their prices change throughout the day, just as they do with stocks. They trade just like stocks. They have ticker symbols just like stocks. Most ETFs are based on an underlying index, and I should note that you cannot buy an index. Indexes are theoretical things. You must buy a fund that tracks an index in order to buy the index. The index tells the ETF what stocks to own, how large to make each position, how to manage the ETF, the portfolio, and so on. So the ETF contains a ready-made portfolio. Each ETF charges an expense ratio, a certain amount of money that they skim off the total money that they have to pay their expenses and to make a profit, and to compensate themselves for providing the ETF to you and to me. Finally, the last item on this display, ETFs pay variable dividends, and for a dividend growth investor, that is an important consideration. ETF dividends, if an ETF pays quarterly, as most of them do, those quarterly payments go up and down. They're not smooth with a stair-step appearance as you may be accustomed to seeing from a dividend growth stock. For that reason, the best way to look at dividend ETF payouts and to decide whether they are growing is to take annual totals rather than just look at each individual payment. I'm a dividend growth investor, so my approach to ranking dividend ETFs emphasizes dividends that grow. For this video, I have applied two cutoffs to narrow down the 200 dividend ETFs available for our purposes here. The cutoffs are, first, that I require more than $5 billion in an ETF in AUM, which is assets under management. So I want to look at large, well-established ETFs. My second cutoff is that an ETF must have more than 5 years of consecutive dividend increases if it's not that large. So either category gets the ETF into the 15 ETFs that pass these simple screens. So to be on my list of 15 finalists, so to speak, the ETF must either be large with more than $5 billion in assets, or it must have a 5-year dividend growth stream. I also want to point out that I'm talking about ETFs that own companies that pay dividends. The ETFs pass those dividends along to you after subtracting out their expenses. I am not talking in this video about ETFs that generate high dividends by selling covered calls or using similar strategies. I've made several videos about those kinds of ETFs, and you can find them in my playlist. This display shows the rating system that I use to score or to rank the 15 ETFs that pass through the screens that I just talked about. If you go down the middle of this display, you'll see the 6 rating factors that I came up with, which are the increase streak measured in years, the yield that the ETF pays, its 5-year dividend growth rate, how many dividend cuts it's had since the Great Recession, so since 2010, its expense ratio, and a fund rating that Morningstar provides for every ETF that they cover. As with all my rating systems, you're probably getting used to this by now. I generally rate factors on a 0 to 5 point scale, as I do here. This slide shows in detail how I assign the points. Anything in the red column at the left gets 0 points, on up to anything in the dark green column at the far right gets 5 points. And the individual factors are shown how the points are assigned. At the bottom of this display shows you how I interpret the scores. There's 30 maximum points available, right? There's 6 categories times a maximum of 5 points each for 30. At the bottom of this display, I show how I interpret the total scores from the system, the ranking system shown above. Moving from worst to best, if a fund gets less than 17 points, I consider it to be uninvestable. I would not invest in it. A score of 17 to 21 is investable. A score of 22 to 26 is above average. And a score of 27 to 30 I would consider to be an excellent dividend growth fund. Focusing back on the Morningstar ratings, they say that their rating framework is meant to be forward-looking and that it expresses their analysts' opinion about the fund's ability to beat its peers after accounting for fees and risk over a full market cycle. I should note here that Morningstar is a total return shop, so when they say beat its peers, they are referring to total return expectations going forward, whereas the rest of my rating system is based on dividend characteristics, not on total return characteristics. One other note I want to make about my own process in boiling down the ETFs for this video. In 1 or 2 instances, I adjusted the payout information to account for payment slippage. Sometimes ETFs allow their December payouts to slip into January of the following year, which puts 5 payments into a single year and leaves only 3 payments in the year of slippage. So strictly by the calendar, that all but makes it inevitable that the year of slippage, the one with 3 payments, looks like a year that a dividend cut was made. I tried not to penalize any ETFs where this happened, so long as the dividend payment wasn't actually skipped, rather just slid by a couple of weeks into the beginning of the following year. Okay, with the information about how I've ranked the ETFs out of the way, let's look at them. This display shows what I consider to be the best dividend growth ETFs. You can see the factors now across the top, colored as they were shown on the prior display as to how many points they get for each factor, and they're listed in order of the total points, which is the column near the right that has the down arrow. So, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, got 26 points and is the highest ranked in my system, and so on going down. I'm going to generally refer to the ETFs by just their ticker symbols because their names are always tongue twisters. VYM got 24 points. DGROW, Dividend Growth, got 24 points also. VIG, which is the oldest and largest ETF in this video, got 22 points. And something called SDOG got 17 points. I considered all of these to be investable. 4 of these 5 got green total scores, and SDOG got a yellow, which is an investable total score. And one thing to note, look at the amount of money. The last 2 columns, which is assets under management and payouts per year, they're white because they didn't play a part in the scoring system, but they have good information. All of these, looking in the last column, all of these ETFs pay out 4 times a year, quarterly, which is what most ETFs do. And the amount of money that's been amassed in these ETFs exceeds $160 billion. So dividend ETFs are a huge business. This display shows the highest yielding ETFs in my group of 15 finalists. All of these have yields over 3%, over 3.2% actually. But you can see that the scoring factors are studded with mediocre scores and with negative scores. 2 of the 4 here got negative ratings from Morningstar on their system. There are a lot of dividend cuts that show up in these ETFs. And they haven't attracted all that much money. If you look at the AUM column near the right, none of them has reached double digits in terms of billions of dollars under management. This display shows the fastest growing dividend growth ETFs, and that's determined by the column that says 5-year dividend growth rate percent per year, but they're not ordered in according to the speed of growth. They are still ordered by the total points over further to the right. Here we see two that we've already seen, SCHD and DGRO, and then 4 others that ended up with scores so low that I personally wouldn't invest in them. You can see that these ETFs have attracted quite a bit more money than the high yielding ones that we were just looking at. They are all in the double-digit billions of dollars range. And finally, this display shows the other remaining 4 ETFs that didn't make one of the earlier slides. I'm not going to spend any time on these. You can read their names and their ticker symbols over in the left. These are studded with bad scores all over the place, and none of them made the minimum 17 points that I would require to invest in a dividend growth ETF. Which ETF is the best one? I did an exercise like this about a year ago. It was one of my first videos. My conclusion this year is the same as then. I think that SCHD, the Schwab US Dividend Equity ETF, is the best one. Of course, as all experienced investors know, no single security is best for everyone. This is my personal choice, and obviously it reflects my own biases and preferences. SCHD's list of positive traits is long. It's increased its dividend every year since it was launched 11 years ago. Its dividend has never been cut since it was launched. It yields just under 3%, which is pretty decent and above my minimum for investing. It has a best-in-class dividend growth rate of 12% per year. It has a tiny expense ratio of 0.06%. It garnered a silver rating from Morningstar, which is their second highest rank. It got 26 out of 30 points on my scoring system, and it has the highest total return in this group. Pertaining to the last point on total return, this display is a 5-year chart showing the total returns of the top 5 ETFs as I scored them. My scoring system focused mostly on dividend traits. It did not consider total return. Nevertheless, you can see that SCHD, my top pick, has the best total return among these 5. SCHD is the purple line at the top of this slide, and it shows that in the past 5 years, SCHD has returned 108% total return to its investors. I should add that I checked, and SCHD has the top total return over the past 3 years, 5 years as shown here, 10 years, as well as since its inception in 2011. It's been a very good ETF, not only for its dividend traits, but also for its total return. This chart shows SCHD's total return compared to the S&P 500, and you can see that this is since the inception of SCHD, and you can see that with a very minor difference, SCHD has matched the S&P 500, represented by the ETF SPY, which holds the S&P 500 as its portfolio, which I think is pretty remarkable for an ETF that's focused on dividends as SCHD is. SCHD's yield is more than twice as much as the S&P 500 yields right now. This is a year-to-date chart comparing SCHD to SPY. You probably know that SPY has been losing money this year, mostly because of a semi-collapse in a lot of technology stocks, which play a big role in SPY's performance. And SCHD, because it's more diversified in that sense than SPY is, has outdone, i.e. has lost less year to date than SCHD has. How does SCHD get its great results? Let's take a look at how SCHD works. A little background detail on what you're buying if you buy a share of SCHD. First of all, as I said earlier, ETFs are based on index. SCHD is based on the index called the Dow Jones United States Dividend 100 Index. To my knowledge, it's the only ETF that's based on that particular index. Point number 2 on this slide, the index screens the universe of stocks that have paid dividends for at least 10 consecutive years. It takes the top half by yield of all those stocks, and those become its universe for consideration to put into the index, to put into SCHD. And by rule, they do not look at real estate investment trusts. Moving to point number 3, once the index has isolated that universe of stocks, create scores for all of them using 4 fundamentals, which it weights equally in their scoring system. The 4 fundamentals are cash flow divided by total debt for each company, which is a measure of financial health, return on equity for each company, which is a measure of profitability, the yield, and the 5-year dividend growth rate. The top 100 stocks under that scoring system make it into the actual portfolio in the index, with this exception. If a stock is already in the index, it stays in if it's in the top 200. So that provides a buffer that prevents some of the churn that would result from constantly replacing stocks and requiring that they all be in the top 100. So a stock that's already in the index from having previously been in the top 100, if it's fallen out of the top 100, but is still in the top 200, it stays in the index when the index is reconstituted. Point number 5, the index, and therefore SCHD, is cap weighted. So the weight of each stock is determined by its total market capitalization, how much the largest companies get the highest weights, with significant exceptions. Each stock is capped at 4% of the index, and each sector is capped at 25% of the index. The important part is each stock being capped at 4%, because the largest stocks would greatly surpass 4% weighting in the index if that rule wasn't in existence. So this is called a modified cap weighting. And the final point, the index is reconstituted each March and rebalanced quarterly. This display shows the sector weightings in SCHD right now, after it was just reconstituted and rebalanced in March. I've put green dots next to the 5 sectors that have a double-digit weighting or higher, which are financial services, consumer defensive, which is to say consumer staples, healthcare, industrials, and technology, and red dots next to the 2 sectors that have no weighting at all, which are real estate, which we saw real estate is excluded by rule from the index, and also utilities, which just through the scoring system haven't made it into the index for 2 or 3 years now. This is a busy display, and you don't need to look at the details of it. I put it up because it shows how the weighting of various sectors varies through SCHD's reconstitutions and rebalancings through the years. This is the latest version of this display that SCHD provides, and unfortunately it cuts off in June of 2020, so it's a little outdated, but it does allow you to see how the rules that SCHD follows allow it to reconstitute the weights and redistribute its money as time goes on and as market conditions change. A couple little details, if you can see it at the top, you see a little tiny slice along the top edge that fades out a couple years ago. That's utilities, which we know now has 0% in it, and you can see that it went to 0% in looks like 2019. And also you could, in the middle, that pinkish area expands starting in late 2019 to a wider, larger proportion of the index that is financials. And we saw that financials now occupy a fairly large slice of SCHD, whereas several years ago they occupied practically no part of SCHD at all. Here's the Morningstar style map for SCHD, and you can see very clearly here that SCHD is what would be called a large value fund under Morningstar's system. 42% of its weight is in the large value style box in the upper left-hand corner, and 75% of its total weight is along the top row, which means large cap stocks. And most of the rest of the weight is in the medium-sized value areas. So you can see where SCHD stocks are concentrated toward the upper left side, upper left corner rather, of the style box. This display is also from Morningstar, and it shows the quality characteristics of the stocks in SCHD. 52% of them have wide moats from Morningstar. Another 30% have narrow moats from Morningstar. And you can see the financial health grade of B and the profitability grade of B-, which are above average grades. The bottom line to me from just looking at this slide is that SCHD contains a very high quality portfolio in its 100 stocks. This table displays SCHD's top 16 stocks by weight. I chose this cutoff because it represents all of the stocks that occupy 2.5% or more of SCHD's total portfolio. In total, these 16 stocks comprise 64% of the portfolio's total market cap. I've highlighted a couple of things on this display. At the top, I highlighted that 40% of the assets in SCHD reside in its top 10 stocks. And I also highlighted the column heading called Economic Moat, again pointing to SCHD's high-quality portfolio. Every one of these top 16 stocks has either a wide or narrow moat from Morningstar. The red dots over near the left indicate stocks that I own in my dividend growth portfolio. I own 9 of the top 16. To me, that overlap suggests a similarity in process, which is one of the reasons I like SCHD, but also enough of a difference that by owning SCHD in my portfolio, which I do, I get some measure of diversification that I have not gotten from my own stock selection processes. This display shows SCHD's annual portfolio growth since it was introduced. So this is SCHD's entire history beginning in 2011. And you can see that on an annual basis, SCHD's dividend has in fact gone up every year with no cuts ever since it was introduced. This slide breaks down SCHD's most recent dividend payments over the last couple of years. And here you can see the variability in the dividend that I said is common to all ETFs that I've ever looked at. So looked at quarterly, it's hard to see that SCHD is actually a dividend growth ETF. But when you gather them up 4 at a time and look at them by calendar year, that's how you know that SCHD has 11 straight years without ever having cut its dividend. This is a 3-year chart now that shows SCHD's yield. I drew the yellow band to show that SCHD's yield tends to stay quite stable, just under 3%. I ignored for these purposes the COVID crash, the flash crash in 20 and its aftermath. Based on that yellow band, my rule of thumb for SCHD is that it is fairly valued at around 2.9% yield. So whatever its price is, if it's yielding at that point around 2.9% or near that or better, it's at a fair value. And that's the rule of thumb I use for purchasing more shares. I own SCHD both in my public dividend growth portfolio and my wife's and my personal accounts, and I consider it fine to add when its yield is in the 2.8 to 2.9% range, as it is right now with a yield that rounds to 2.9%. Any yield higher than that, of course, represents a bargain price on SCHD. Okay, we're almost at the end of the video. I thought I would finish up by pointing out which of the ETFs in this video are the best on individual factors. The highest yielding ETF, dividend growth ETF, in my group of 15 is PEY with a 3.8% yield. But notice that only got 14 points on my scoring system, so it's not one that I would invest in. I wouldn't chase the yield for that reason. The fastest growth ETF is SCHD, my top-rated ETF, with a dividend growth rate, a 5-year dividend growth rate of 12% a year, and that got 26 points on the scoring system. 2 ETFs tie for the longest dividend growth streaks, SCHD and VYM, both with 11-year streaks, and they scored 26 and 24 points on the system, the 2 top scoring ETFs. The lowest expense ratios are, there's 3 of them, SCHD, VYM, and VIG all have expense ratios of only 0.06%, which is tiny, and they all scored well on my scoring system, 26, 24, and 22 points. There are 3 ETFs with the fewest dividend cuts since 2010. SCHD, VYM, and DGRO all have no cuts since 2010. And they also scored well. They are the top 3 scoring ETFs in this study. And finally, the highest Morningstar rating goes to VIG with a gold rating. It's the only one of the group of 15 that got a gold rating from Morningstar, and it scored well with 22 points. And that brings us to the end of this video. For those of you that are still with me, thanks very much for watching, and I will see you next time.